Hey there, folks. Jim Cramer here, and let's talk tariffs. In the simplest terms, a tariff is like a tax on goods coming from another country. Countries use tariffs for different reasons, sometimes to protect their own industries, sometimes as a bargaining chip in trade deals. But here's the thing about tariffs. They can have a ripple effect throughout the economy. Think of it like this. When you put a tariff on steel from another country, it makes that steel more expensive, right? That means companies in the US that use steel, like car manufacturers or construction companies, have to pay more for their raw materials. Those higher costs can then get passed down to consumers like you and me, meaning we end up paying more for cars, appliances, or even new homes. Now, some people argue that tariffs protect American jobs and businesses by making foreign goods less competitive. Others say that they can lead to higher prices, hurt consumers, and even spark trade wars with other countries. It's a complex issue with no easy answers. What we do know is that tariffs can create uncertainty in the market, and as investors, we don't like uncertainty. So when we hear talk of tariffs, we need to pay close attention and understand the potential impact on our portfolios. Remember back in 2018 when President Trump slapped tariffs on steel and aluminum imports? He argued it was a matter of national security, saying we needed to protect those industries to keep America strong. Well, those tariffs definitely shook things up. The price of steel and aluminum went up, which was good news for some domestic producers. Companies like Nucor, Alcoa, and Steel Dynamics saw their stock prices jump as investors bet on them benefiting from the tariffs. But the tariffs also led to retaliation from other countries, who put their own tariffs on American goods. That trade war created a lot of uncertainty and volatility in the market. Some industries, like agriculture, were hit hard by the retaliatory tariffs. And while some argue that the tariffs ultimately protected American jobs, others say they cost jobs in industries hurt by the trade war. The 2018 tariffs were eventually lifted, but they serve as a stark reminder of the potential consequences of protectionist trade policies. The lesson here: tariffs are a powerful tool, but they can have unintended consequences that ripple throughout the global economy. Fast forward to today, and guess what's back on the table? That's right, steel and aluminum tariffs. Former President Trump has hinted that he might bring them back if he's re-elected. He's sticking to his guns, saying it's crucial for national security and protecting American jobs. Now, we've been down this road before, and we know it can be a bumpy ride. If these tariffs do come back, we can expect to see some familiar patterns. Steel and aluminum prices will likely rise, which could benefit domestic producers like Nucor, Alcoa, and Steel Dynamics in the short term. Their stocks might get a boost as investors anticipate increased profits. However, we also have to consider the potential for retaliation from other countries. China, the European Union, and others could impose their own tariffs on American goods, sparking another trade war. That could hurt American businesses that rely on exports and lead to higher prices for consumers. The bottom line is that these tariffs create a lot of uncertainty. It's unclear how other countries will react, how long the tariffs might stay in place, or what the ultimate impact will be on the economy. So, what's an investor to do in this environment? First of all, don't panic. Remember, volatility is a part of the market, and we can use it to our advantage if we're smart. One key strategy is diversification. Don't put all your eggs in one basket, especially in sectors that could be directly impacted by tariffs like manufacturing or agriculture. Spread your investments across different sectors, asset classes, and geographic regions to reduce your risk. Another important strategy is to focus on companies with strong fundamentals, regardless of the political climate. Look for businesses with solid earnings, strong balance sheets, and a history of weathering economic storms. These companies are more likely to emerge from periods of uncertainty in a strong position. And remember, it's always a good idea to consult with a financial advisor to get personalized advice tailored to your individual investment goals and risk tolerance. They can help you navigate the complexities of the market and make informed decisions that align with your long-term financial plan. Stay informed, stay diversified, and stay focused on the long term. That's how we make money in the market, folks.